I'm going to start the weekend report with a look at the currencies. The dollar has dropped back below the 10-day moving average. We're going to try again to break this trend line. I'm not going to consider this as a daily cycle low at this point because it did not break the trend line. Um, there has been kind of a pattern though that these big down days are followed almost immediately by an up day. The dollar bulls are pretty confident that the dollar is going up, so they tend to buy anytime we get a big move down. So we may retrace a little bit on Monday. Moving on to the weekly charts. Again, this is clearly a 3-year cycle low, and this is a rally out of the 3-year cycle low. Um, if I was a dollar bull, I would be concerned that this 3-year cycle low dropped below the 200-week moving average, and in the first daily cycle was only barely able to get back above it, and the second daily cycle is not holding the breakout above this previous intermediate cycle peak. So there's risk here that this cycle could left translate. And we finished the week at the lows of the weekly candle. So if we get any weakness next week, this could potentially form a swing high. And if we come back down below this 200-week moving average, this does not look like a healthy market to me. If the dollar was in a strong bull market, it just really has no business dropping below the 200-week moving average in the first place, and then proceeding to struggle to try and regain it. Moving on to the euro. Notice that this intermediate cycle was extremely long. I think it's possible that this could turn out to be a short intermediate cycle to even out the yearly cycle after this really long cycle here. Again, we've kind of got the opposite view in the euro. If the euro was in a strong bear market, it really has no business being above the 200-week moving average. You can see here we've gotten above it and we've tested it, bounced, tested it, bounced, testing it again here, and now that 200-week moving average is starting to flatten out. So if it does turn out that this is a short intermediate cycle and we just got our bottom here with another test of the 200-week moving average, then we could be off to the races during this intermediate cycle. And as you'll notice here, we're getting a steady divergence here as the euro has made these multiple tests. The TSI has diverged and it's turning up again. Another thing that makes me think that this may be a short intermediate cycle and we may have found a bottom this week. We've got a similar look in the yen. A move above the 200-week moving average and then just multiple moves back and forth above it. This looks like we've probably put in an intermediate bottom here along with euro. The yen, the 200-week moving average is already turning up. So this looks to me like a market that is trying to turn and start a long-term bull market. And all of this has connotations for the dollar. If the euro and the yen are trying to move above and turn their 200-week moving averages up, then the odds are pretty strong that the dollar started a bear market at the beginning of 2017, and that cycle runs about 15 years, which would mean we've probably got about 6 or 7 years for the dollar to move down into that bear market. Right now, we're trying to roll over the current 3-year cycle. So my opinion is that this 3-year cycle is not going to get anywhere close to this 2017 high and confirm that the dollar is still a bull market. I think this 3-year cycle is it's already started out very weak, and I think it's going to roll over. And I think there's a decent shot that this may be the top of the 3-year cycle right here. And then we should have till probably 2023, maybe 2024, before the bear market and the long-term bear market in the dollar would be over. So moving on to gold, the implications are pretty clear. If the dollar has begun a bear market, then there's a good chance that this consolidation phase that gold has been in for a while may be over. As we can see here, the gold is at least flattening out the 200-week moving average, which is what we want to see to confirm that the bear market is over. And I do think the bear market ended right here in December of 2015. So the next step would be to get above this 200-week moving average, and that would mean that this daily cycle, which I'm pretty sure started last week, would need to get above this 1246 level where gold was capped during that first daily cycle. And I'll also point this out. This occurred on week 10. If gold fails to get above this, then we're going to have probably a left translated intermediate cycle, and then gold would come down, and presumably it would move below the August low. But I'm not leaning in that direction. The dollar made a higher high. You can see gold wasn't even close to making a lower low, so gold is already starting to resist the dollar. We've got a new daily cycle started here, and if gold can get above this, it's going to right translate this intermediate cycle out to, well, if it would do it next week, it would be week 14. And if the cycle right translates, then the odds are that it is not going to drop below this low. All right, so as of Friday, I'm pretty sure this is going to mark a daily cycle low. We're 3 days into the cycle. One thing I noted that the dollar bulls, they tend to buy any kind of large move down, so we may start the week off next week with a little weakness in gold, but I don't think we're going to come back down and break below this low. And for whatever reason, these gaps on the GLD, even though GLD only trades during market hours and gold trades 24 hours, but they just always seem to fill. So early next week would be a prime opportunity for this gap right here to fill on GLD. Looking at the miners, GDX anyway has broken above its cycle downtrend line, so I think we have confirmation that the cycle bottomed. But again, just like GLD, we've got a gap right here, and we've got kind of an indecision candle on Friday. So I wouldn't be surprised if the metals give us a quick little move down early next week to fill this gap before the daily cycle continues. All right, so moving on to the stock market, we do have a swing in the S&P. We didn't quite get there in the Nasdaq 100 on Friday, but we do in the S&P, and the head and shoulders pattern here is still intact in the S&P, and if we can break this trend line, it's going to have a target a little above 3,000. And I think we just came too close to 3,000 right here in September to not get there. So I'm just not buying the perma bears call that we've started a bear market. Bear markets just don't start with a crash like this. They start in denial, and we've had anything but denial. Sentiment has gotten very bearish. The retail traders, the dumb money traders, are very bearish. They're still very bearish, even though we've got a pretty nice bottoming pattern here, and the retest of the lows here in November was nowhere near as severe as the retest back in February and March. Um, but this has just lasted long enough and been frustrating enough that most dumb money retail type traders are convinced that a bear market has started. So we've got a lot of fuel to drive this move, and I suspect there's going to be, if not a final deal, I suspect there's probably going to be some kind of progress made on the trade wars um, at the G20 meeting. You know, the president was able to work out a deal with Canada and Mexico, and ultimately, of course, there's going to be a deal made with China. So that could be a potential trigger to um, deliver this next move up, and I do think we're going to go above this high. I think we're going to get to 3,000, but this was a very long intermediate cycle, so we should have a short cycle to follow. So I'm going to say that we're probably only going to get 2 daily cycles here. So I would say before the FOMC meeting on the 19th, we're probably going to retest these highs, and then the next daily cycle, like into the February time zone. This is when the yearly cycle low is going to be due in February or March. So I'm going to say the first daily cycle is probably going to give us most of our gains, and it may come as some kind of a progress on the trade wars. And then I think we have probably another move down after the Fed hikes rates again in December. All right, so we can see the dumb money confidence is still extremely bearish, so there's a lot of fuel for a big rally. And if we get a very aggressive and violent rally back up to the all-time highs very quickly in a matter of 3 or 4 weeks, I think that could push the dumb money confidence level back up here close to an excessively bullish level, and then that could drive another move down into the next intermediate and presumably yearly cycle low in the spring of next year. And as I pointed out before, when smart money is bullish, it's usually best to follow behind them and try to do the opposite of what the emotional retail type traders are doing. And right now, smart money is bullish. And you can see just generally, historically, it has paid off to follow this group of traders rather than to allow your emotions to control your trading habits. So pretty good chance it's an intermediate bottom. Same thing. Smart money's bullish, intermediate bottom. Smart money bullish, intermediate bottom, and so on. There's just almost never been a spot where it was a bad idea to become bullish when the smart money confidence index is bullish. And finally, a look at the McClellan oscillator. This push out of the bottom here in October was one of the more powerful thrusts since the move out of the 4-year cycle low. We on the retest, we've come back down to test the zero line here, and now we're starting to bounce again. So I'm pretty convinced that we've just had a retest. I know it's been scary. Emotions tend to override logic, and even though we really didn't come that close to actually retesting the October lows, the emotions kick in, and we start to extrapolate that since the market had gone down, and didn't follow through on that first push out of the bottom, that we were in a bear market, and that the retest was going to fail, support was going to break, and then we were going to uh, get an 87 style crash, but that's just very unlikely, and I don't think there's much chance of that happening at this point. This has all the earmarks of an intermediate cycle low and a retest, and one that really wasn't even that um, severe of a retest, and now we've had a pretty big up day and on a fairly decent volume, and it looks to me like the McClellan oscillator is wanting to turn and move back up. So I think the retest is over. Next week tends to be a pretty good week generally for the stock market. We've got the FOMC meeting on the 19th where they want to raise rates again. Uh, I suspect the market is going to be either at the all-time highs and that head and shoulders pattern is going to be playing out and in progress, or we're going to be pretty darn close to the all-time highs in time for the FOMC meeting on the 19th. So, yes, this was a very scary correction and a very frustrating and trying retest of the lows. But in the big scheme of things, I think this is just a sideways consolidation, which was much needed after this tremendous run out of the um, last 4-year cycle low, and especially out of um, the election intermediate cycle low here. This was a very powerful run here in the stock market, and we either had to go parabolic from here and complete a bubble phase, or we were going to have to go sideways, and clearly the market chose the sideways path here, which is a signal to me that this probably means we're in a long-term bull market that still has 10 or 15 years to run. If we had elected the parabolic phase right here and just continued, to skyrocket higher, then I would say that this was probably a bubble. But pretty sure at this point that we're in a long-term bull market that probably still has another 10 or so years to run, and this was just another very trying correction, and we're going to have another one, and probably in 2020 that's going to be as bad or probably worse, something more on the line of what happened here at the last 4-year cycle low in 2016. So that's still ahead of us, but I do not think this 4-year cycle has topped yet. I think we still have further to go, and I think there's a reasonable shot that the NASDAQ can at least get close to or test that 10,000 level before this 4-year cycle tops. And in the much bigger picture, you can see here the retest of the 2000 highs. It took quite a lot of sideways trading before we could break out, and a consolidation this large is not just going to produce a 2.5-year run and then we're over and back down we go. I'm pretty confident that this is just a consolidation. We broke out here above 5,000. We made it to 8,000. We've had a nice pullback. We've reset sentiment. And again, like I said, I think there's a reasonable chance that we can get at least close to or up to 10,000 before this 10-year cycle tops.